Thanks so much for tuning in. My name's Joel Kieran from Ally Wealth Management. In this video, I just wanted to run through some short, sweet, hot tips to go through for those Australians living abroad and working, that if you incur tax liabilities here in Australia, could be an easy, efficient way to try and reduce those to very minimal or nothing at all, depending on your circumstances. So all of this information is just general. I've received a lot of this from the ATO website, so you can definitely use that as a reference point, or get in touch with your registered tax accountant. So by all means, let's jump straight in. So one of the things that I want to talk about today is concessional contributions. So superannuation is by all means probably one of the most efficient, tax-effective long-term retirement income strategies here in Australia. And what you can do is make what we call a concessional contribution towards your superannuation to claim or offset any sort of income tax liabilities that you incur here in Australia. So under the current rules, the current concessional contribution cap is $27,500 per annum. So that means you could essentially add a contribution to superannuation up to the balance of $27,500 per annum and claim an immediate tax deduction on that contribution. So this is really handy for potentially some of our clients living and working abroad that may have, for example, positively geared investment properties here in Australia. As you would probably know, investment properties are taxed here locally, and they will be charged at non-resident tax rates. So, it's 32.5 cents from that first basically dollar. So what you could do, if you have $20,000 in positive rent that you receive every year, you could potentially add a contribution of up to $20,000 to essentially reduce that personal income tax liability to nothing. So if you have any questions regarding that, feel free to get in touch and we'll go through it a little bit more in depth and make sure that that's working for you. Whilst we're on the topic of super contributions, a recent government change allowed us to be able to use what we call carry forward concessional contributions. So whilst the concessional contribution cap is $27,500 per annum, if, for example, you have a more significant income tax liability in any particular year, you can use these carry forward concessional contributions, so unused concessional contributions from prior years, to make a larger one-off lump sum to negate any sort of larger tax liability that might go beyond the $27,500. Some important things to note regarding this, though, is obviously you have to have been eligible to have made concessional contributions in prior years, and your total super balance should be less than $500,000 in order to qualify for these kinds of concessional contributions. If you have an investment property here in Australia, one of the key things that we can use is repairs and maintenance. Now, the ATO is quite specific when they define repairs and maintenance versus property enhancements. So it's really important that when we're doing any sort of capital works to our investment properties, that we're considering, is that a repair and maintenance or is it capital works? So under repairs and maintenance, it's things like we need to return something to its original state, such as your hot water system has just blown up in your investment property. That needs to be replaced or repaired. That kind of replacement or repair would be considered a repair or replacement. So you would get an immediate full tax deduction for that one-off expense. However, if you were to do any sort of more significant capital work, such as renovations to the property, new carpet, potentially new painting in preparation for essentially a release of that, in most cases, the ATO would define that as an enhancement to the capital value. So that would need to be dealt with via a depreciation schedule. So you would probably have to speak with your accountant or I suppose specialist that does a depreciation schedule for you to calculate that over to depreciate the cost of that capital works over the following preceding financial years. Another good way to claim an immediate tax deduction on your investment property is what we call the prepayment of interest. As we mostly all know, interest that is incurred on loans for investment properties is tax deductible. So what we can do is we can arrange with the bank to essentially have a prepayment of interest, potentially up for the next financial year, and you can claim a full deduction on that one-off expense. This will obviously be quite helpful if you have events that are probably more significant in incurring income tax liabilities here in Australia. So by all means, if this is something that I suppose you're willing to consider, feel free to get in touch with myself. We can go through this, or get in touch with your bank to arrange, is that possible for a prepayment of interest for the next financial year? And generally as well, if you're living abroad, there's a couple of other things that generally will be still tax deductible here in Australia. And these could be things like fees for managing, I suppose, your professional financial affairs. So these could be fees that you're paid to your accountant, paying to your financial advisor. These things are generally tax deductible as well. And then in some circumstances as well, if you hold an income protection policy in Australia, these things as well could be tax deductible to you. So by all means, that sort of wraps up all of the points that I've got in my video for today. So if you have any questions, or you want to, I suppose, go into a little bit more depth with this, feel free to get in touch, book a meeting, or speak to your tax accountant. Otherwise, if you like these videos, please subscribe to our channel and follow us on social media. It's been great to have you tune in. Thanks so much.